When you hear the word accounting, let's be honest, your mind probably jumps to spreadsheets and taxes, right? But it's so much more than that. It's actually this incredibly dynamic field of problem solving, one that's evolved to tackle some of the biggest challenges in the global economy. And we're going to start with a problem that affects every single global investor.
Okay, so imagine you're looking to invest. You're trying to decide between two absolute titans, Apple and Samsung. You pull up their financial reports, ready to compare. But what if they're written in completely different financial languages? How can you possibly be sure you're making a true apples-to-apples comparison? You see, this is a huge problem for investors all over the world. And that exact problem, well, it sparked our first big evolution in accounting. The quest to create a single global financial language that everyone everywhere can understand.
The solution is something called accounting standards. Now, the easiest way to think about these is as the official rule book, the grammar, if you will, for financial reporting. Their whole goal is to make sure that no matter where a company is based, its financial story gets told in a way that's transparent, consistent, and here's the most important part, comparable. Now, this did not happen overnight. No way. This has been a slow, deliberate grind that's taken decades. It all kicked off back in 1973 with the formation of a group called the IASC. By 2001, that group evolved into the ISB, which started issuing the IFRS standards that are so widely used today. And you have major economies like the US and India that have been working for years to align their own standards with this global framework.
And what's the result of all that work? Well, today, an incredible 144 jurisdictions require these international standards for their public companies. This whole push for a common language has fundamentally changed how global business gets done, making it so much easier for capital to flow across borders.
But, it's not like everyone speaks the exact same dialect. There are really two main philosophies. You've got IFRS, which is used by most of the world, and it's what we call principles-based. It gives you broad rules and then trusts accountants to use their professional judgment. Then you have the US standard, known as GAAP, which is more rules-based. It tends to be way more specific, trying to provide detailed guidance for pretty much any situation imaginable.
And believe me, these differences have huge, real-world consequences. Just take India's move toward IFRS. Under their old system, there was no general requirement to consolidate all the financial statements from a parent company and its subsidiaries. Under IFRS, that's a must. How you recognize revenue is different, even how you state your compliance is different. These little details matter a lot.
So, okay, we've figured out how to compare companies, but what are we actually comparing? Think about this. What's a company's most important asset? It's not the factories, it's not the computers, it's the people. And how in the world do you put a value on that?
And that question leads us straight to our second big evolution in accounting, the really controversial and super complex idea of trying to value human capital.
Scholar Eric G. Flamholtz defined this idea, called human resource accounting, or HRA, perfectly. It's not just about payroll. It's about a total mind shift, treating the costs of hiring and training people not as expenses that are gone forever, but as investments in long-term assets.
So why would you even try to do this? Well, the goal is to make better decisions. If a company starts seeing its people as actual assets, it can start to track whether that investment in them is growing. It forces management to really acknowledge that the skills and experience of their team are a core part of the company's value.
But this is incredibly difficult to do in practice. I mean, there's no single standard method that everyone agrees on. How can you possibly estimate the lifespan of an employee at a company? And unlike a machine that just wears out over time, a person can gain experience and actually become more valuable. These are the massive challenges that have kept RHR largely in the world of theory for now.
Okay, so standardized numbers help investors compare companies, and valuing people could help managers run them better. But what happens when the numbers aren't just complex, but are being used to lie? What happens when they're used to commit a crime?
And this brings us to our final section, the absolutely fascinating world of forensic accounting, where accountants basically become financial detectives.
If you want a perfect example, just think of Bernie Madoff. For years, he was producing financial statements that looked completely legitimate. It took forensic accountants to dig deep, to look beyond the surface of the numbers, and to finally uncover one of the largest Ponzi schemes in history.
So, what is it exactly? Well, forensic accounting is this really unique blend of skills, part accounting, part auditing, and part investigation. These professionals are trained to conduct examinations that are so thorough they're suitable for a court of law. You see, they don't just check the math, they look for the story behind the numbers.
Their process is pure investigative work. They dive into these incredibly complex financial situations. They trace where the money went. They compile all the evidence. And then, and this is crucial, they have to be able to communicate what they found clearly, often as an expert witness testifying in court.
And their skills are in demand just about everywhere. They work on major criminal cases like securities fraud or embezzlement, but also in all sorts of civil disputes, like figuring out the damages in a contract breach or even tracing assets in a messy divorce. They really are the financial bloodhounds of the legal and business worlds.
So, as we've seen, accounting is anything but static. It has evolved from just a simple record-keeping tool into this highly sophisticated discipline that creates global standards for comparison, that grapples with how to value human potential, and even uncovers massive, high-stakes financial crimes.
And this journey of solving new problems is far from over. Which leaves us with one final thought to chew on. As our economy becomes more and more dominated by things we can't physically touch, like data, a company's brand reputation, and AI algorithms, what new frontiers will accountants have to explore? What's going to be the next great challenge for them to figure out how to measure,